Hey there, everyone. Welcome to our latest episode of the Market Misbehavior podcast. I'm your host, Dave Keller, and thanks so much for joining me here on the podcast. Our goal with the Market Misbehavior podcast is to sit down with top market practitioners, investors, traders, money managers, strategists, authors, educators, anyone we can sit down with virtually or in person to talk about the market conditions, to understand a little bit about their process and what makes them tick, how they approach the markets, their routines, their techniques, their strategies, and try to learn as much as we can from their own lessons learned over successful careers in the industry. Really fun conversation to share with you today. Ben Emons. Ben is a Dutch market strategist, founder of FedWatch Advisors. He spent his career, studying Fed and Fed action, a lot of his experience in the fixed income markets, and he really brings some great wealth of knowledge about Fed history and Fed activity to analyzing the current market environment. I had a really fun conversation with Ben, touching on a number of things. Had some inflation data that came out just before our interview, CPI and PPI numbers in February. So I was able to get kind of an instant reaction to those data points. Talk about the differences between CPI and PPI and the PCE, the personal consumption expenditures, which is a favored measure of inflation by the Fed Chair Powell and other Fed governors. We talked a lot about the U.S. dollar, the strength in the dollar, what that means for U.S. versus non-U.S. markets, particularly as the dollar is starting to weaken here at the beginning of 2025. Talked about rate hikes. Are they on the table for 2025? Talked about how Ben would grade the Fed's performance so far during this rate cut cycle. And overall, it's just a really interesting conversation. What a pleasure to be able to sit down with someone like Ben, ask questions about inflation, the dollar, the interest rate environment, Fed policy decisions. And if you've been confused, if you've been struggling to get your head around what this whole Fed policy sort of thing means, I think you'll really appreciate a smart and knowledgeable Fed watcher sharing some of his insights and lessons learned along the way. So please enjoy this recent conversation with Ben Emons. Ben's the founder of FedWatch Advisors. So super excited to sit down today with Ben Emons. Ben's the founder of FedWatch Advisors. Ben, great to see you. Great to meet you virtually. I've followed your work and been very fascinated to see how you're navigating these markets. And it's so exciting to be able to ask you some questions today. So thanks for joining me on the show.
It's great to be on, David. Thank you very much. It was great to connect with you, and I'm looking forward to the conversation.
So I feel like our cup runneth over of things happening in early 2025 with all the different macro influences. And I'd love to get your take on a number of things. Let's start with some of the economic data that's coming out this week. We had CPI, PPI numbers over the last couple of days here, latest inflation data. The market has moved pretty quickly in reaction to those numbers. As you're reflecting on the latest inflation data, what does it tell you about the overall conditions here and what we should expect going forward?
Yeah, we're now realizing that we have inflation that's not going to go away that easily. There was a view out there that, if this Fed raised rates, that inflation coming down quickly from 9%. We sort of really slayed the inflation dragon is the popular term, but it's like the idea of we did do the right thing and we got inflation down and we got it down. And Powell said that, yes, we made a lot of progress at 2.6% last year. But these numbers have started to look more stickier than people had foreseen. And there's a lot of different nuances to it. I do think what's happening is that the tariffs are beginning to impact the inflation, both through expectations channel, but also through financial conditions. And as that is happening, you get this sort of additional pressure. In addition to that, you have these one-off items like eggs or other type of food items, or in this case, shelter's a little stickier again for all these technical reasons. So I think it's a picture where inflation does look like to have somewhat of found a bottom, around 2.5%. It may go up a bit for a while, and it depends on what the Fed will do next, right? They stay restrictive, so they won't cut rates, but if they have to reverse course, that will be the big change here that actually were to happen if it were to be necessary to try to get inflation back under control. So right now we're sitting here, it's okay, and PPI is a little softer today, and that gives the market a lift, but that's all one-day events. I think if you look further out, the expectation for inflation in the markets have started to drift higher, and also in consumer surveys, and we have to really pay attention to that because that could indeed drive inflation higher.
It's interesting. I mean, Chair Powell and others have talked about this 2% target, right? That's the goal, is to get inflation down toward that number. And early in the rate cut cycle, it felt like that was just kind of happening, right? We're having this Goldilocks scenario. We're kind of getting in closer and closer. I feel like as we've gotten closer toward 2%, it still kind of feels like the goalposts are moving further down the field. Is that a reason? I mean, should we be expecting to actually get to that point? Or is it more the idea of striving for lower inflation that the Fed's really trying to accomplish here?
Yeah, I think that's the latter part is I think the way to think about it, because to them it's that in order to try to really anchor these expectations, you have to continue to have that message out there that you will get back to 2% and that you will do everything to get there. Because if you look at these surveys, they're not much higher than 2%, and on averaging more than 3%. Right? And so the Fed takes notice of this, obviously. Now, these are bias surveys and maybe smaller sample sizes, but they are an indication of what people feel and think about inflation, what they expect from here. So that message of 2% is really key. And Powell has many times said on different occasions that, they have 25 years of success of having inflation close to the target. And so they do feel you have to get there, because that is that success. You get a better economy with inflation close to stable around 2%, than perhaps stable what it looks like apparently at 3%, but it may not be stable. And that's kind of what we experienced yesterday. Right? We sort of saw like prices aren't so stable, even at you sort of hovering just below 3%.
No, that's really interesting, and I appreciate you talking through that. It's definitely felt more and more as time has gone on that 2% is sort of an aspirational target that we'll kind of get toward, but the markets are seeming to take Fed actions to date fairly constructively. So we sort of went through a series of rate cuts starting toward the end of last year. Now we sort of stalled out and no real expectations of change in Fed policy here in the next meeting or two. How would you, I mean, if you're the professor of the Fed governors, how would you grade their performance so far? I mean, I've read some and heard some suggest that maybe the early, more aggressive, the 50 basis point cuts may have been too much too soon, and maybe that has impacted markets. How would you grade the Fed's sort of policy decisions so far over the last 6 to 12 months? Do you feel like they've been on the right side of things, or things they should have done maybe differently?
Yeah, that is an interesting question, because yesterday's testimony the day before was that one of the congressional members gave them a credit, saying like, you're in the soft landing,
Yeah.
you're supposed to get some credit for it. Why don't you take credit? And he was very cautious. He doesn't want to take credit because, as you described, like they have to make certain policy decisions, maybe somewhat more dynamically at certain points in time to actually sustain that soft landing. So I grade them as doing a good job, that so far the economy has held up well in soft landing, right, so to speak, coming from a very high peak in the pandemic, that we're making a good stride to a stable economy around 2.5-3% real GDP growth consistently. But then the grading that you were giving on the timing of the decisions can still be questioned. In September last year, to do the 50 basis points, I looked at that saying they wanted to give the economy a little bit of a swing into year end, because they had a forecast of the unemployment rate of 4.4%, giving basically the message like, we don't want that forecast to happen. We don't want the labor market to deteriorate from here. That's not acceptable, almost that type of language. So they said like, better to go bigger and give the economy more of a push. And they were right about it. Like the unemployment rate started to moderate again.
Yeah.
But now we're here in the start of the year, and we're having 100 basis points of cuts behind us. And although long-term interest rates have risen by about the same amount, the real interest rate has fallen and actually has made financial conditions and the monetary conditions less restrictive and my financial conditions looser. Against a picture here that starts to develop that we may be in a phase where inflation could be moving higher from here for all reasons, tariffs, expectations, or the economy in itself. And so you have to grade them now on saying like, you're getting I think for the 50 basis point cut, you get an A for getting the unemployment rate down, but you're getting a B plus for the inflation that did follow a bit from that, right? There's no free lunch, and they know that. There's no perfect balance between unemployment rate and inflation. And they plug these into the Taylor rule today. It does give you an output that the Fed is neutral, so 4.5%, is what the prescribed rule should be if you take the history of that rule. But that's just a snapshot. I think the next step here, if they go for cuts, I would give them a B minus, because that's not the right timing. But if they ratchet up their hawkish language by saying, we really want to be ahead of the curve again, and we're going to maintain restrictive, if needed, we're going to become more restrictive to use tools, I would give great M&A for that, because you want to get ahead of this potential resurgence of inflation. And I think that's what they're getting at. That's what they're going to. I think the testimony from Powell yesterday was in that sense the tone about. There was in one section that he was asked about tariffs, that he said, forget about tariffs. We will use all our tools to get ourselves to 2% inflation. So no matter what happens, the Fed will do its job to control inflation. And I think that's the course they're on, and the course they will stay on.
No, that's well said, and there's that dual mandate, right, of the Fed of keeping inflation in check, but also maximizing job growth, or maximum jobs, and there are times when those goals seem to be in conflict. I feel like that's maybe one of those times where we're coming through. You mentioned tariffs a number of times, obviously, and then a lot of news coverage, a lot of speculation about tariffs, and certainly it's been sort of one day after the next. It's unclear as to what's going to happen, what headline's going to hit. I mean, how inflationary, based on what you've heard so far, based on your own expectations, I mean, how much of a hit would tariffs actually be? Is this something investors should be concerned about? Do you think it ends up being a non-issue for other reasons? I mean, how do you think of tariffs and their potential impact here?
So the Fed put out a forecast for 2025 PCE that would go up by 0.4%. And I think they factored in the previous analysis they did in 2018 of what tariffs could do initially to inflation, like an initial jump in prices. But it's also much about the choice of any of the producers or companies, what to do with the tariff, how much to pass on. And there's mixed research on that. There's been only a handful of categories in the previous trade war that it was fully passed on. Whereas in a lot of categories it was not, because of the competitiveness of sales process, right? As in, we can maybe not necessarily pass it along that easily, unlike what you've seen in food inflation, where you've seen pass-through coming through from higher wages more consistently, because a lot of food companies and restaurants want to not deal with just simply stickier wages to have their business operate. A tariff is a different story. There's also adjustment here, right? So there's anticipation by consumers, they start buying, so it could drive up inflation a bit, but then you have the currency that could strengthen, it could somewhat offset that effect from imported inflation. So I think if I come down to say, like, there will be an impact of a few tenths of a percent more with the Fed's forecast, and so the street forecasts have come out with 1 to 1.5% for PCE. That seems a bit too high because it's very linear. It's like, yes, universal tariff, which is, by the way, now in effect on all Chinese goods coming into the United States. We may see some of that coming up in the next PCE and CPI reports of what that means, which will give us our first evidence, right, of what that actually entails, how much is really passed through. I think there's a lot of lag there of how it gets passed through. And it's very specific in terms of microeconomic decisions that are taken by consumers and by producers. So I summarize and say this is a not an easy process to gauge. Tariffs seem to be causing more uncertainty then that could affect the economy rather than the linear impact on inflation. But that they're being put in the context of inflation, the one major change that has happened is in expectations, clearly, right? And as I mentioned, that is important to keep in mind, because expectations are leading, and if they become more leading, then it does lead to broader price increases. People just simply anticipate inflation to continue to go up, so they're going to continue trying to find goods in the store that I think they're still cheap enough before they get, more expensive, right? And that's a dangerous process, right? So, there's a little bit of that going on. In some of the surveys, you see a little bit of that sort of psychology appearing. And that's where the Fed has to be very, very attentive.
You had mentioned earlier the PCE, right? The personal consumption expenditures, which, sort of the Fed favored version of inflation, or an index that they prefer to watch. For those that are less familiar, when we throw around terms like CPI, PPI, PCE, how does personal consumption expenditures, the PCE, how does that relate to the sort of the kind of classic measures of inflation, CPI and PPI, that I think people are a little more familiar with?
Well, the big difference between CPI and PCE is that PCE is based upon wages, or based upon incomes.
Right.
That's how it's driven. It's how it's constructed. It's how, it's measured in terms of people they spend on what they earn, and therefore that affects the price. So that I think that's the big difference. Where CPI is more of a statistical measure on how to measure price changes of different categories of goods. PPI is just only one measure of it, but the interesting thing is that PPI has certain components that are feeding into the PCE. You know,
Hmm.
what's an interesting component there to mention is what they call portfolio management and investment services. That's
Okay.
also inflation, right? If you and I are charging fees for people trade stocks, bonds, you name it, right? There's all fees generated. It's part of the calculation of PPI, and it feeds directly into PCE. So that's an interesting anecdote from how inflation and financial conditions are related to each other. And if stock markets go up a lot, you can expect probably more volumes and more fees paid and lead to some sort of inflation. It's not like a big weight, but something like 2% of a weight into each index. So that is significant if you're getting 20, 30% type of gains in stock markets that drive all these fees, right? So I think to summarize it, the PCE is about income and spending, driving prices. CPI is statistical. PPI is sort of in the middle of the two. Obviously, the three are always watched, but I think for PPI that we saw today, it's about materials and energy and commodities, right? So it's a very commodities measure of inflation, and it can sometimes be kind of fluctuating more than the CPI does.
You had mentioned that's super helpful, Ben. I really appreciate that. You had mentioned in your comments about tariffs, impact on the currency potentially, and the dollar, which strengthened, for a while, instead of lightening up a little bit. We're starting to see in 2025 for a number of reasons. I feel like non-U.S. markets starting to outperform U.S. markets, and that change in the dollar could be a part of that. How what's sort of your outlook for the U.S. dollar, and how would that impact equity investors thinking about valuations, thinking about U.S. versus non-U.S. positioning? What sort of impact does the dollar have for us, do you think?
Well, on one hand, it's a positive story that if the
Mhm.
dollar starts to strengthen again on the economic backdrop that is strengthening, then that's a good story. And we've had these phases over the last sort of, say, 6 to 12 months. Certain dollar movements higher and the stock market went higher, even the yields went higher. The worry I have, though, about the dollar is that it could gain significantly more strength if the Fed has to reverse course. It has to go from this neutral stance to a tightening stance, and even
Yeah.
really making the tightening an actual potential decision, right? And that's could lift the dollar significantly, but that I don't think will be as positive for markets. It will tighten financial conditions. And to your point, you're seeing the flip side of with the euro this year being weaker. Obviously, it's helped manufacturers in Europe. It tends to be very correlated, but it's also across the board gains in Europe in terms of I guess maybe the way I thought about it was that are the tariffs an incentive for European companies and economies to think about inward more about how to bring more things inward, and that the reliance on US imports are shifting at some point because of the tariffs. If that's the
Mm.
case, you're going to get the stock market potentially outperforming because it's in valuation terms such a different, the big gap between valuation of equities in Europe and in the US. And I think that plays a little bit of a role too. People have recognized the gap. We're definitely in a more overvalued type territory here in the US. If whatever measure you want to look at, something of like, at least historically, seems to be the upper end of the ranges. But Europe obviously is in the other side of it. So you could argue that there's also a bit of that coming into play, like people looking ahead saying, if this tariff situation does really make changes, like reordering of global trade flows, does this drive to more inward investment in a place like Europe, where they have really lacking investment and they have lower interest rates, by the way, and lower inflation, that could be beneficial to the equity markets in Europe, and that markets are now anticipating this cycle.
No, very, very interesting. I appreciate it so much, Ben. And it's so interesting. I mean, the trend in the dollar has been, so clear, and all of a sudden, excuse me, starting to change a little bit here, year to date, and I think it's starting to open questions about what could come next. You'd mentioned, the Fed's potentially, the idea that they could, have a tighter policy here at some point. Looking at the CME FedWatch tool, not much expectation of any sort of change in, any sort of increase in Fed rates anytime soon. And I feel like a couple months ago, if you suggested the Fed might raise rates, you probably be laughed out of the conversation pretty quickly. What do you see that as a potential scenario, and what conditions do you think would lead up to that potential outcome? Because I feel like the market is kind of pricing in kind of flat, maybe a couple, more rate cuts through the course of this year. What would need to happen for the Fed to have to really change that course? How would they navigate that kind of change in policy?
Yeah, the only person who has been very vocal about it has been Michelle Bowman, who has
Mm,
actually consistently said that the rate hike was an option for her. Not so
yeah.
much about, it's always an option, right? Anything is an option, I guess. But to her, it's really about like if we just don't see this inflation picture improving from here, which means consecutive declines further from here. So the 2.6 from last year goes to 2.4, 2.2. That just doesn't happen. Then in her mind, the Fed should consider a rate hike. So I think that's
Mm,
one part of the condition. If the progress not only stalls out, but actually starts to reverse, right? We go from 2.6 to 2.8 to 3, and we don't make any more progress, the Fed has to reconsider a reversing course. Now, the challenge there will be the communication, how to do that, because as you mentioned, the expectations are absolutely not there.
yeah.
Even though, what's interesting though, as I mentioned, is actually in those probabilities from the FedWatch tool, that shows still cuts priced, and it still shows an expectation eventually the Fed will be able to bring rates down. But if you look at where the futures curve is priced and you look at the Fed's own forecast of rate cuts, there's now a bigger gap there, particularly 26, 27 or further out. The market's priced much more closer to maybe like 25 basis points away from where we currently are today versus the Fed thinking they could actually be doing much more rate cuts in the future. I think that's where the real communication change will take place, is that the Fed will start looking at saying, what happens here today changes really the course of our path in the future. We have to lift all those projections back up again. And you get that mark to market idea that we've had numerous of times, the Fed marking itself back to where the market is. Then in that case, the impact would not be so material because essentially the market is priced for a shallower path and the Fed is adjusting to it. But the communication that comes along with it will always cause volatility no matter what. Anyone who comes out that was previously saying that they were more in favor of cuts and switches around to like, I think we do need to keep in mind that we may have to tighten, something in that nature. Goolsbee was an example recently.
Yeah.
That brings surprise elements. Waller, as an example, I'd be very curious how he would speak these next few days whenever he speaks, because he looks at these point-to-point data releases and he may really quickly can changes his mind about inflation, right? And he's done that before. So things like that will drive the volatility around the messaging. Whereas if it comes to the long-term forecast, it may be right that the market may be right. This is a shallower path. This is a maybe higher neutral rate too, but it's mostly driven by inflation. Further out in the future, the path has to be adjusted higher. That will be the major change. And there will always be an adjustment in long-term interest rates as a result of that, because the term premium, as we talk about, which is this excess return, if you strip everything from Fed expectations, inflation, and anything else out, you get a return left in the yield that
Mm,
investors demand to hold that long-term bond. It's currently 35 basis points. It's positive. It was for a long time negative, but it's not a lot. The average, long-term average of that term premium is closer to 1%. So I
mm,
would think that if the Fed changes this course and changes the communication and adjusts those forecasts up back to the market, that the term premium will go up, and that would make also the yield curve again somewhat steeper, and long-term interest rates will adjust a bit higher as a result. So I've been of the long-term view that Treasury yields at 5% or above seems to be more reasonable at the time we are now in terms of the
mm,
economy and inflation than when they are down here at 4.5 or lower than that. And I think each time that we dip lower, like we had recently, just a number of days ago, market very quickly recognizes that that is probably too low of a level. Why we reprice back to 460 from 436 to 460 in literally a day or two. And so
yeah.
that too is an issue, right? Because a lot of volatility of interest rates has been sort of consistent. And I think this is a reflection of this messaging that the Fed is challenged by. It wants to bring rates down because it has won the battle of inflation. Therefore, its long-term it could meet the long-term neutral rate of it, where they estimate around just below 3%. So bring the Fed funds rate down there, and inflation is at 2%. So in equilibrium. But clearly, there's a very bumpy direction towards that, very bumpy, trip towards that, if you call it that way, like a plane, right? Like try to land it. So the soft landing in the economy is working, but the soft landing with the Fed funds rate seems pretty bumpy.
There's plenty of turbulence in the markets right about now, right?
Yeah,
I think that's a fair way to describe it,
yeah.
for sure, man. So, I mean, just to finish up here, I mean, so help us understand this. I mean, if you're a money manager in mid-February 2025, given all these discussions that we've talked about, given the uncertainty about the Fed and policy decisions, the interest rate environment that has generally been trending higher. How do you position yourself right about now? And have you seen enough to suggest that you should be changing? Maybe I know a lot of investors probably very overweight kind of the growth AI trade after an exceptionally strong 2024. Do you see reasons to be pivoting, to be reallocating? How do you position yourself going forward? Where do you see opportunities here?
Yeah, I'm definitely in the camp of the ongoing rotation away from the Max 7 into other sectors. That's been on and on going on. Sometimes it gets pulled back, and then it comes right back again. And I think today was a little bit of another example of that, where you get a little bit softness of data, that rotation starts to pick up. And there's still a rate cut sort of driven psychology behind it, I think. But it's also recognition that, that little bit softness is it's all about the economy, obviously. But people, I think, recognize that we're just not over-concentrated in the economy. There's a lot of growth in other areas. And the goal is, obviously, with this administration, is to pull more money into the United States one way or the other, which should benefit a lot more sectors than just technology. We also know that in the government sector, there's big changes ahead of us, right? There's going to be a major change in the labor force of the federal workforce. And what would that mean for the economy? How would that be reallocated? There could also be a feel for potential rotation opportunities away from tech into other areas. If these people come in there and productivity picks up in those areas that are more undervalued to tech, say, think of staples, materials, financials, energy, those type of areas, or even consumer discretionary to an extent, against another backdrop of we do have a global picture too. Right now, foreign markets seem to be outperforming US markets. And that could also change, I think, at some point if this rotation picks up more. So I'm about trying to diversify from the tech sector, which is very concentrated, to more broader exposure and add in the international diversification. I think that's a good approach for this year.
That's well said, Ben. Listen, this has been such a pleasure. I mean, and again, it's been so fun to follow your work, but what a great joy to be able to ask you some questions about Fed policy, about positioning, about all the questions that I feel like a lot of investors are dealing with. So thank you so much for joining us. Hartelijk dank. Is my Dutch pronunciation passable there?
Excellent pronunciation. Hartelijk dank, graag gedaan. This means you're welcome. So
Very nice.
thank you, David.
It's a pleasure, Ben. Thanks again. I hope we can talk again later this year as we debrief on everything going on. But thanks again for coming on today.
You're welcome. Thank you.
What a great conversation with Ben Emons of FedWatch Advisors. I really appreciated Ben's comments about that 2% inflation bogey. I remember hearing that initially when Fed Chair Powell announced that. I think that was early 2024. And just watching how the Fed has taken different actions, how they've been able to bring rates down in terms of the short end of the curve, the prospect of further rate cuts and what they might mean, but just sort of that mirage, that 2% bogey that just seems sort of off in the distance. And I really appreciated Ben's perspective on how that's more of an aspirational level, most likely, and it's more, sort of expresses the fact that they're really trying to, keep rates low, or at least keep inflation in check, do what they need to do so. I thought, particularly given some of the uncertainties with the new Trump presidency, I thought, Ben's comments about tariffs, potential inflationary reaction to tariffs, and what it could mean for equities, for interest rates, I thought was really, really valuable. Hope you enjoyed that conversation with Ben Emons. And again, I really appreciate being able to sit down with someone like Ben and ask him questions about, topics that are thrown around so often in the financial media, so often in financial publications and media, and just being able to understand a little bit better. And I thought Ben did a fantastic job of boiling down some of some very confusing topics, I think, at times for a lot of investors, kind of making it make a lot of sense here. So hope you enjoyed that conversation. We've got a lot more great interviews lined up here for the Market Misbehavior podcast in the weeks and the months to come. We're always looking for ideas for others to sit down with. So wherever you're listening to this podcast, if you can drop a comment, let me know who you think would be a great guest on the pod, and we'll look forward to approaching them for sure. Also, as a reminder, if you want to learn more about some of the technical analysis tools, some of the strategies that we would use to track some of the points that Ben was making, actually analyzing interest rates from a technical perspective, analyzing the US dollar, US versus non-US stocks, and just the general performance of the equity markets, all from a technical and behavioral perspective. If that's of interest, I think our Market Misbehavior Premium memberships may be an interesting thing for you to do to upgrade your decision making, improve your market awareness, and provide some of those tools and techniques to help you better understand the market environment. 3 great benefits that you will all find on our website at marketmisbehavior.com/premium. Benefit number 1, virtual courses to teach you the building blocks of technical analysis and behavioral finance, all on demand at your own pace. Second thing would be access to our members only reports, our weekly flight plan, which is our main report we put out every weekend, where we focus on levels, patterns, signals we'll be focused on in the week to come. And also our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and analyze performance and trend characteristics. Finally, you'll have access to our members only community. It is a growing and active community, really thoughtful investors. It is a group of like-minded investors navigating these markets. You can do it along with them and along with me. I'm in there every day answering questions, giving words of encouragement, and pointing out different signals and patterns that I think are important to watch. You have the opportunity to see what others are asking about, and I hope and I believe it will help you improve your own market awareness. Go to marketmisbehavior.com/premium for more information. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That's it for today for Market Misbehavior. I'm Dave Keller, and remember, it's always a good time to own good charts.